We fully expect them to make at least a quarter cut, and I think, based on what we're going to talk about next, we're thinking it's going to be even higher.
Hello, everyone. This is Matt Thomas with Brian Dewald. Together, we have been doing Mortgage Minute now for several years, trying to bring you the best information in real time, I should say, best news and information that affects mortgage rates and ultimately buying or selling homes. Brian, we have some really great news to share, especially right out of the gate here.
Yeah.
The best rates that we have experienced in the last 11 months. Tell us about that.
Yeah, so there's been a really good rally here, pretty much since and I'll bring up a chart and show you here momentarily, but a really good rally since the beginning of August. Early August triggered a jobs report, right, that fell short of expectations. The woman that was in charge of the BLS has been fired, recently here over the last couple of weeks. It was all sort of kind of related to bad data. And so, anytime that the actual employment numbers fall short of expectations, it's usually pretty good news for mortgage rates. We've seen that in back-to-back months here, in kind of a trend of improving interest rates over the last 4, 5, 6 weeks. So it's been great news.
Yeah, there's no doubt. So it's always kind of a yin and yang kind of a thing. There's always some balance, right? If we have some unfortunate news in the job market, the silver lining to that is that we have more favorable interest rates typically, right? So we've actually seen this 11-month dip, or this sort of best in the past year rate has been in the low sixes. So I've seen it as low as about 6.25, and it's just slightly off of that today. As we all know, that always depends on kind of how well you qualify and such, but and these things are fluid. It tends to move up and down, as the day goes on and the weeks progress. But right now, there seems to be a lot of optimism for the way that the home buying market should kind of improve based on rates. Brian, what are you seeing in the market on your side of things?
Yeah, I'm seeing more and more buyer activity, right? Whether it's actual contracts coming in or, folks reaching out to me that are curious about buying houses, and, we're strategizing about how to put the best offer together. You and I had back-to-back closings last week, and I think both folks ended up in the low to mid 5% range on a 30-year fixed rate. So, it's kind of neat when we can strategize some of those things to take advantage of the market conditions.
Yeah, there's no doubt. We hit on it, I think, every time we do a Mortgage Minute, but even when we quote something like a 6.25 rate roughly, there's always opportunities to buy that down if you're a buyer.
Yep.
and put yourself in a much better position to be more like in the fives. And I mean, yeah, as you mentioned, we have real life examples of that just happening in the last couple of weeks for folks that we're working with together. What are you seeing? I guess there's a lot of talk about what's going on with the Fed meeting coming up.
Yeah.
And, it's been projected, especially, sort of mainstream news that, that there's maybe a rate cut coming to the bank, the federal bank rate.
Yep.
You can tell us about that?
Yeah. So, the first thing we've talked about this, quite a handful of times on our show here is that, there's not a direct correlation between Fed rates and mortgage rates, right? The federal funds rate is the overnight rate at which banks lend each other money. There's not a direct hit to the mortgage industry. And oftentimes we already expect or anticipate what the Fed's going to do, right? So we fully expect them to make at least a quarter cut. And I think, based on what we're going to talk about next, we're thinking it's going to be even higher. If we see 0.25%, I'd be a little surprised if it wasn't more than that. I think we're going to see a 0.5% rate cut from the Fed this go around, which is coming up just on, I think it's Monday the 15th, coming right up.
Right. Yeah. So a big thing going on, big meeting coming up on Monday. So if we see that 0.25%, I know, we're not prognosticating anything here, but that 0.25%, there's a lot of belief that has sort of been already widely accepted, that the interest rate has already sort of fallen and adjusted because of that anticipated Fed bank rate that's going
Correct.
to potentially move by 0.25%. If it moves by 0.5%, that could actually be some pretty good news for interest rates, would you say?
Yeah, I think that anytime there's going to be some good movement in there, it could be positively. Now, the direct day to day, right? If we open the market up on Tuesday and we see some deterioration in the mortgage world, I wouldn't be surprised, just because that's that initial kind of spike or hit that happens. But I think the overall consensus would be that's pretty good news for us. The reason I think that it could be as much as 0.5% is based on some data that came out today from, it's called the QECW. You'll have to look that up. But they basically report actual job hirings, right? We kind of talked about this a little bit before we started here. And what they're doing is they're showing the actual jobs that were posted in comparison to the job report that comes out every month. And they don't give us a general month by month adjustment, but they did decrease the job population by 911,000 jobs over a 12-month period. It's by far a record. Averages out to be about 76,000 jobs per month. And I think with that news coming right before this Fed meeting coming up, that might urge them to take a bigger dip than we were initially anticipating, at least last week. So, that's a monster number, right? 76,000 jobs per month on average. Overstated is a problem. So hopefully they'll look at that and determine that, gosh, we need to make some adjustments here. The job market is not nearly as red hot as they were acting like it was. So we'll see what happens next week. We can come back and report on that.
Yeah, that feels like what's going on in a nutshell, right? You've got these overstated numbers. They're basically inflated. This financial information was used as a way to, make adjustments in the rate and make economic decisions by those who make these decisions, primarily the Fed. And then all of a sudden you end up with, a much softer jobs report, and you end up with then now having to sort of revise that. And when you realize that sort of overnight that the job situation is basically not nearly as robust as we had been reported, well, you can imagine that's going to change everything, and maybe potentially quite quickly. So, yeah.
The other thing
I'm used to tuning in. Go ahead.
Well, I just wanted to add. So the big one that came out was September last year, right? There was a skyrocketing number in September. And I don't know if you'll recall, but that was the peak of interest rates. So the September's report came out early October. That's really when we scratched that 8.125%. Didn't last too long, but that was the peak of mortgage rates too, right? So the fact that this data is so wrong is really kind of putting a thorn in our side, right? Just as far as rates and prices and home prices and, all the stuff. It's just, hopefully they can get this right, and we'll all be in a little bit better condition for it. For anybody that's looking to buy or sell real estate.
Yeah, and again, that's the silver lining of it all. So while this is not so great information, if you're someone who's directly affected by, a softer job market, certainly, if you are in the housing market and you're looking to buy a home, this may be the sort of break that you're looking for. So I've kind of been saying to anybody who was, listening essentially that I think that, possibly your best chance to really jump on these, improved rates, these rates that we haven't seen, for almost a year, is really that window potentially closes and rates potentially go up if we don't, if the Fed doesn't really drop rates. If they do exactly what they're expected to do, we may actually see rates go up a little bit. And that's certainly, remains to be seen. However, I wouldn't anticipate just from that, that they would go up a ton. But, we always talk about it. If the rates drop significantly, supposed to be bringing people off the fence and into the buying market. Right now, there's really ample opportunity to take advantage of, some of the increased inventory that we've seen. Now, this time of year, the increased inventory that had been building throughout the summer will start to dwindle because we won't see as many homes going on the market in the fall as we do typically in the summertime. So opportunities, they tend to, they tend to be short-lived sometimes. We would like to think that, that we're heading into a fall where with the softer jobs report, we're going to see much better rates for a longer term. But I guess it just remains to be seen. So for those who are already in the market and looking to take advantage, rates right now, again, they're the best they've been in close to a year. And this may be the opportunity. And obviously, it remains to be seen if they drop any further. Well, that being said, then, sometimes we tend to do these Mortgage Minute updates when there is something significant to update you on. We anticipate meeting again next week because that next Fed meeting certainly is captivating the mortgage world, I think, and anybody who's paying attention to interest rates. Be interesting to see what they decide to do, and hopefully that will be a positive impact for real estate rates and home buying in general. All right, Brian, I certainly appreciate your time, and we'll look forward to connecting again, especially if we get some super positive news, or whatever, however that turns out after the Fed meeting next week. We'll look forward to getting back together and sharing our thoughts on that.
Sounds great.
Until
See you
then,
then.
thanks for tuning in.